Welcome to the show. You're listening to SashaTalksTech, a podcast about technology, innovation, and entrepreneurship. My name is Sasha Prokhorova. I'm an engineer and a language analyst. With every episode, I'm bringing to you tech professionals from all over the world, sharing their knowledge and expertise. We have gathered here today to eradicate barriers towards technology, education, and opportunity, together with each episode. Today, we're going to talk about financial technologies, also known as fintech, a quest towards improvement of financial services and algorithms behind their automation. Our guest today is a researcher, a software developer, a data scientist, a machine learning engineer, pursuing PhD in computer science. He is a co-founder and a COO at Data Invision, a fintech company based in Riga, Latvia. Data Invision combines financial expertise with fully automated prediction solutions for data-driven decision-making. Ladies and gentlemen, it's my greatest pleasure and privilege to be introducing to you Rihards Fuksis. Hi, Rihard. How are you doing?
Hi, Sasha. Very good. How are you?
Great. Pleasure having you with us. Thank you very much for joining.
Thank you for inviting me.
Today, we're going to be talking about fintech. It's been such a big buzzword in the media lately. So, Richard, can you tell us a little bit more about it? What fintech is and why is it so important nowadays?
So, fintech actually is divided in several segments, and the one that mostly pops in mind is like some kind of money transfers, maybe some lending, and mobile applications for fast payments, maybe also insurance and other technologies. But mostly with fintech is associated also machine learning, which is used in I think every part of it, and yeah, such as customer segmentation, evaluating the credit risks and detecting fraud.
Okay, so the AI algorithms help us decide who is a trustworthy customer in terms of lending, what kind of credit limit to give them, and what's their risk in terms of taking them on board as a customer, right?
Yes, exactly. And if we touch topics such as customer segmentation, for example, it's like the first thing is to understand what is the customer actually, and what the customer wants. So basically, there's an opportunity to offer him some specific product, for example, as a targeted ads, and like customized goods, books, movies. Also, yeah, as you mentioned, the customized credit limit when he applies for a loan at a lending company or a bank, or a customized investment plan, maybe regarding of his age, income, and other parameters.
So you can calculate his probability of default and adjust the product that you offer him accordingly.
Yes, exactly. And mostly for that, the credit scoring main goal is to evaluate the credit worthiness of a client and his probability of default. So banks and alternative lenders want to maximize their profit, and therefore they want to issue loans to customers which will uh, pay back money with interest and reject loans to those who will probably default and will make them lose money.
Wow, we definitely lived in the era of human decisions being challenged by AI algorithms. So, do you think we are cutting costs by eliminating third parties like credit bureaus and other offices by giving loans to people at a faster rate and all by using AI algorithm?
So if we look at the lenders, for example, they usually use several sources of data, not just credit bureaus, for example, to evaluate the credit worthiness of their customers. First, of course, the loan application data such as age, gender, income, liabilities, and other. Then, of course, the credit bureau data, where they check if client had a loan previously in some other bank, maybe in some lending company, okay, if they had any previously delayed loans in past. And also there's like bank statement data, like clients' transactions, income streams, outgoing transactions. And here I can mention also the transaction categorization and labeling, which is very important. So at this step, if we have this kind of data, we can categorize all of the transactions in like predefined buckets. For example, salary or gambling or groceries or any other types. It depends on the particular use case where this data will be used, but the main idea is to use these categorized transactions to understand the spending habits of the customer.
Interesting. So you're looking through historical data, so searching for patterns and trying to make sense of it. And this is how sometimes you can find the occurrences of fraud, right?
Yes, exactly. And there are different types of fraud. So the fraud actually is one of the biggest problems, and there are like credit card fraud, such as accessing victims' credit card
So
and
like an
spending the
identity
money.
theft
Yeah,
fraud.
identity fraud. So companies try to fight this by different anomaly detection algorithms. And for example, my mother was also a victim of credit card fraud attempt. Her card was skimmed at an ATM, and the details of the card were sent to, I know, some Canarian Islands where they tried to make a payment of $3,000. Luckily, she didn't have so much money on her bank account at that moment, and the transaction was caught by some transaction anomaly detection algorithm, and her card was automatically blocked.
So the account was flagged by that anomaly detection algorithm because it wasn't a usual transaction for that particular customer.
Exactly. I guess my mother haven't made so big transactions, and as she lives in Latvia, and the transaction were tried to make in Canarian Islands, it was really suspicious, and that was a good job done by the bank.
Wow. So do you think fraud techniques also evolve with the technology as it evolves?
Yes, of course, of course. Technology usually drives like both sides of like good and evil. When technology evolves, so does the methods which are used to make different attacks, scams. This is like never-ending story, like a war between the good and bad guys using the same available technology, and each of them trying to push it forward and therefore advancing it also.
Yeah, and like good and bad always competes with each other, trying to one up one another, and that's a never-ending process. There will always be fraud, and there will always be people in fintech and cybersecurity who would be fighting this fraud.
Exactly.
So yeah, I wanted to talk about the technical aspect of let's talk about model customization. I know you train those models to detect anomalies and make credit decision and personalization and everything. But is it common for you guys to recycle those models in fintech just to customize them a little bit and fine tune some parameters and reuse them for multiple use cases?
Well, for bank, for example, they can use one model for underwriting for a long time, a year or even more. For our alternative lenders, which are our clients, it's crucial to adjust to ever-changing like regulations and shift in population. So great model, which was developed like 3 months ago, could perform poorly if the population has changed or some new business processes introduced. this is one of the problems we try to target with the Data Invision, and therefore we have created the platform. So it would be really easy to retrain, like recalibrate the model within hours, check their performance, and deploy to production fast. Also, every company aggregates new data every day, and it is crucial to add this data to the training set so they keep up with the changing population. And many companies still do the recalibration manually. Usually the data scientists work on data extraction, cleaning, pre-processing, feature engineering, and training, and then just give the results to developers to deploy the model to production. However, that's slow and boring, which can also introduce some human error and lead to incorrect predictions in production. So yeah, that's why an automated platform for managing it and recalibrating models fast is the key thing to keep up with the fast-paced environment.
So it eliminates the human error out of this whole chain, basically.
Human error, I mean, in the case if several teams work together, from my previous experience, for example, when data scientists extract data, analyze the data, build the model, and give this model to software developers to deploy to production, they need to extract the data in the same way. And this was one of the points where they usually somehow manage to extract or pre-process the data in a bit different way. And actually, the result of the predictions were totally different.
Okay. I also wanted to talk about the models that you guys use in your production. I know a little bit about logistic regression and decision trees and random forest. So I was hoping you could walk me through the process a little bit more.
So yeah, regarding logistic regression, banks still like to use logistic regression because it's easy to explain the impact of each variable. Uh, the similar situation is like insurance, where there is a need to license the models and explain the decision-making process. But in fintech, I would say that technology is more advanced. They're willing to use latest state-of-the-art methods, which can bring more profit by using much precise models. Therefore, I would say, depending on the application, algorithms such as decision trees, boosting algorithms, neural networks, and other are very popular in fintech, and they can still be explainable.
Uh-huh. So you're saying with logistic regression, it's easy to see cause and effect, but it's not very flexible as some more sophisticated models are?
Yeah, but with sophisticated models, there's easier to find more patterns in data, which can bring to valuable information and therefore better understand the customer behavior.
I remember last time we spoke, we discussed the custom variable that you invented. You call it the overfit coefficient. So what is it
Yes.
about and why is it so helpful in what you do?
So when we developed Data Invision platform, we created our own hyper parameter optimization and iterative feature elimination algorithms. What this means is that we search for the optimal hyperparameters for the model and also optimal features within hyperparameter space. In this process, we train like several hundred models until we find optimal. And this is guided by the overfit coefficient, the parameter that we introduced. This parameter actually incorporates several variables, such as area under the curve of the rock curve on a training set and cross-validation set, so we don't overfit the model on a particular data set. And it's also used, we use feature count and properties of the rock curve together. So we incorporate like several parameters into this one variable. Therefore, this information like guides our training process and obtains the best possible model.
So basically, the overfit coefficient that you invented is a tool that helps us avoid overfitting.
Yes, helps us avoid overfitting and helps to find the most precise model also. So incorporating both of the good things that we want to achieve.
Wow, this is really brilliant, actually. I've been reading a lot about overfitting. So yeah, this is really, really interesting concept. So yeah, I was just wondering, in fintech, people talk a lot about the time series analysis. So I wanted to ask you, what does it entail and why is it done?
Yeah, so time series analysis is a hot topic. So time series analysis can be applied to basically any set of variables, which can be represented on the time scale or some discrete grid. So historically, like analog signals were represented as some time varying quantity. We can imagine just voice signal, which changes over time, right? Or for example, how temperature changes during the day, month, or year. However, now almost every signal is represented in digital form and also data that changes over time. And in this case, we can look at the temperature change, for example, over the day. But in digital case, each reading will be taken, for example, every second or minute, therefore creating the vector of time series data. Similar is with previously mentioned transactional data. If we categorize transactions, that we can see how many transactions in particular category were made and for what amount. We get like several vectors where x-axis will represent time, for example, day or an hour, and y-axis will represent the amount of money spent or the balance, how it changed over time, right? And by using these time series vectors, we can then apply machine learning algorithms to extract different features, which will give detailed representation of clients' spending patterns. And we incorporated this machine learning block within Data Invision system also when we perform feature engineering step. Usually this can generate like several thousand new features that can be used for the training.
Wow, so the time series, just to sum it up, it just gives us data over time and how it changes. It could be customer behavior, it could be spending, or it could be anything. It's just an overview of the trends over time.
Yes, exactly, as also stock market changes or something similar, yeah.
So yeah, so time series are basically very important to make prediction, to detect fraud, and they're very helpful for the investment just to see where the stock market goes toward.
Yep.
Yeah, and I've also been wondering about the neural networks. I know they're used a lot in fintech as well to detect suspicious behavior. And do you guys, I'm pretty sure you guys use them as well, right?
Yeah, we incorporate also neural networks. So regarding the suspicious behavior, uh, basically it can be interpreted as anomaly. And for example, if we have a data set where 1% of the set is comprised of anomalies or differently represented samples, they can be detected either with unsupervised learning algorithms or with supervised learning algorithms, or even in some cases both in sequence. So if the anomalies comprise small amount of data set, person can just label this set and then proceed with any classification algorithm or neural network algorithm. If data set is large, what people usually do is use autoencoder neural network. So autoencoder neural network has the same number of neurons in the input layer as in the output layer. And basically the job is to encode data into some smaller uh, smaller space and decode it back to reproduce the input. And autoencoder neural networks are commonly used for dimensionality reduction. And so if the anomalies comprise a small part of the dataset, model will like miss it and fit the remaining data, therefore will be able to detect these anomalies in future.
Wow, this is so fascinating. I've actually been reading a lot about the neural networks. For those who are not too familiar with them, neural networks have the input layer, the output layer, and several hidden layers in between them. The amount of hidden layers varies depending on the neural network. And basically, you give the neural network, let's say, an image, cat or a dog. And while it goes through the neural network, the output gives you a decision if the image is a cat or a dog. But I didn't realize you can mix supervised and unsupervised learning on the neural network. That's kind of a new information for me. This is amazing. So what about the dimensionality reduction? Do you think it simplifies the anomaly detection task?
Well, yeah, it can. So basically, what does the dimensionality reduction do? So if we start with this input layer, right, and we have like 100 neurons in the input layer, so we can go down to, for example, 10 in the middle layer. So it will reduce the starting dimensionality from 100 to 10 and like map these dimensions to lower dimensional space. And after that, try to decompress or decode it back to this 100 dimensions if we have like 100 output layers. So therefore, this encoding and decoding is kind of encoding the most important information into these lower dimensions, and therefore we can just leave out some like not so relevant information about the smaller part of the set, which is like 1%, as previously mentioned, for example, and therefore it will be able to detect such kind of anomalies.
Wow, this is so fascinating. So for those who don't know, neural networks can be written from scratch, but nowadays there are libraries that exist that can simplify the task of creating a neural network. Those libraries include Keras, TensorFlow, and so many more. So what libraries do you guys use in Data Invision? I'm presuming you are writing in Python, right?
Yes. So mostly our go-to language is Python. Some of the code is also written in Java. But yeah, mostly Python, and it depends on the application, but Keras and TensorFlow are very popular libraries indeed. PyTorch is also gaining popularity, I would say. Scikit-learn is also popular for those who work with Python. We are also using H2O library, which has Python bindings and can be easily used for training different models and also bringing them into production. So yeah, lot of choices, but my suggestion would be just to try one and see if it works for you, and
Mhm.
then try
Yeah, of
another.
course. But for those listeners who are just starting to familiarize themselves with the neural networks, which library would you recommend as a good starting point?
For those who are just starting, I would say you can start also with Keras because the interface is not so not so hard, but for people who haven't coded anything, maybe the H2O graphical user interface is the way to start digging into the neural networks, because you can just drag and drop and click and try several configurations and check what you can get.
So you would say the H2O library is a little bit more user-friendly, just because it's mostly images and the nature is more like drag and drop. Does it mean it involves less code writing?
There is available graphical user interface. We don't use it, but I know some of the data scientists use it, but yeah, and for people who don't want to code and just want to try out neural networks, yeah, that's a great way to start digging into the neural networks. And I would say the next step would be to try out Keras with the TensorFlow, and yeah, and build something on top of that.
This is excellent. So H2O library is a great beginner neural network interface. This is amazing. Thank you for that. So basically, we use all those libraries to create neural networks and help make sense of disorganized historical data. So what Data Invision does, you guys gather all the historical data, it may be structured or unstructured, and you make sense of it using all those models and neural networks just to make sense of it and to create recommendations.
Well, we have like several steps in our pipeline, as we call it, for data organization. Usually we have some part of the data which is organized, such as an SQL table, but then we deal with some files which are XMLs, JSONs, or even Excel spreadsheets. It depends on our customers. These need to be organized before feeding the data to the training. Therefore, we have automated data pre-processing step and feature engineering step. During the integration with our clients, we connect every different data source of data to a dedicated processing and feature engineering task to ensure that at the beginning of the training we have structured data to build the models.
Wow, this is so interesting. So I was just wondering about the social impact of fintech. So, of course, era of human decision making being overwritten by algorithms. So I've just been wondering about your personal opinion of, do you think fintech is capable to be removing barriers, or is it just creating them in terms of, let's say, algorithmic lending has often been seen as a possibility to end discrimination based on race and gender. And a lot of people say in the United States, the mortgage discrimination declined because all those fintech algorithms appeared. Actually, John Detree, he's a journalist from Quartz. He's a future finance reporter. He talked a lot about this, that it actually helped decrease the discrimination in lending for mortgages. But I was wondering, so since the personal gut feeling is now replaced by science and tech, it should even the battleground on the one hand. But on the other hand, once I think about it, fintech algorithms are written by people, and people still have biases ingrained in them. It could be age bias, gender bias, or it could be even racial bias. So, and since the algorithms have such a black box nature to them, they can't explain their own decision, and plus the lack of human interaction. Could those algorithms be bringing maybe even more bias into the lending decision making?
Well, yeah, bias is the problem of modern AI. If we use biased data for training, we will obtain biased model. And there was an article regarding that. Let me remember it. It was something about biased algorithms are everywhere, and that no one cares about that, something like that. And in this article, researchers discuss the negative consequences that can arise if bias is not identified. So this can impact particular communities, minorities, genders, and algorithms which might be biased are already used to make important decisions, such as who gets a loan or who gets a job interview, for example. And a key challenge is that companies show interest in monitoring and limiting this algorithmic bias. But I can also understand why companies are not so transparent maybe about their data or algorithms that they are using. They are afraid of competition, and mostly they do not have so much workforce to address these issues to monitor this algorithmic bias.
So, would you think that it's not the algorithm per se that's biased, that's data that's being fed to it that is biased in the first place? Because, like, garbage in, garbage out, as they say.
Exactly. So if we use like gender-specific data or race-specific data, then the algorithm will try to find the patterns, try to find the correlations with this data and with the target that the model is being trained on. So that's yeah.
Yeah, of course, because algorithm would mimic the behavior of their trainer. It reminds me of the story. A good friend of mine adopted a beautiful pit bull puppy in New York, but he rescued her from somewhere. Just beautiful puppy. But he brought her with him here to San Francisco. And it turns out that the dog doesn't like people of different skin color. And nobody could understand anything. She was just afraid of everyone who was not white. And I was like, oh, wow, I wonder if the previous owner, whom my friend rescued the dog from, maybe if he had the same biases, maybe the dog wasn't around a great diversity of people before, and she's never seen this type of diversity before, and now she's terrified. So that's kind of like an analogy that brings to my mind.
Yeah, exactly.
Yeah, so I was also wondering, since everybody uses social media nowadays, well, not everybody, but the majority of people, do you think the social media behavior might be playing a role in, like, let's say, in determining their risk levels or how responsible they're going to be? Or are the companies even allowed to have access to this kind of information?
Well, social media is another source of data for machine learning algorithms. So depending on the application, if it is possible to find correlation between data found on the social media and customer behavior in some platform, either it's lending platform or some other platform, then yes. For example, if a customer is registered on LinkedIn and what is his job title and interests. And if we look at micro lending, then most of the customers, I guess, won't be on LinkedIn, but I might be wrong. And also Facebook, like Facebook data that you can find on Facebook and is publicly available, that could be also useful. For example, what is particular person's interests on Facebook, what pages he likes. There's also possibility to analyze images and try to interpret what types of images particular person is posting on Facebook or liking on Facebook. Uh, Possibilities are huge and data is all around. And, some people generate huge amount of data on publicly available websites. The question is, can companies aggregate, process, and use it like in a meaningful way and comply with the GDPR rules and other laws. So, but yeah, if data is basically publicly available and if you use it in not personalized way, but try to find some patterns, then yes.
So basically, social media is a publicly available data, and we should all be careful about what we post there. I was just curious. Let's say if I post, if I enjoy running with the bulls or skydiving, would some fintech algorithm automatically flag me as a person who likes risky behavior, and I would be classified as a less desirable customer? Or is it not that simple? There's more factors that are involved in this decision making.
I guess it's not that simple because for us it feels like it's like straightforward that you take on more risks than you're a more risky person to take a mortgage or something can happen to you during the mortgage process. But from the algorithmic perspective, it depends if you have enough data, like historical data with such cases, then the algorithm might find some correlation and use this in this manner. But I think it would be more like an outlier than correlation.
So the algorithms take into consideration like your profile overall before they make a decision about you whether you're a desirable or an undesirable customer. It takes more than just couple posts.
Of course, it should do that. It depends, of course, how it's executed.
Sure. So yeah, I was just wondering, we also live in a world where everything is instant. People demand instant gratification, instant payments, instant delivery, just quick everything because the world that we live is so fast-paced. So I was just wondering, for your opinion, do you think instant transactions would mean increase in fraud immediately?
Well, if managed correctly, this is excellent use case in today's fast moving environment. However, yeah, this can cause problems if not used with particular responsibility, I would say. If the management of transactions are done properly and that is very convenient. On the other hand, this gives less time to act if transaction was fraudulent, right? And the main focus, I guess, should be to identify fraud before it has happened. Like with the cryptocurrencies, you can make almost instantaneously transactions, great technology, but it's being abused by speculators, and it's easy for non-technical people to make costly mistakes, like transferring some funds to incorrect address or whatever. So yeah, it depends on the execution.
Of course, especially with cryptocurrencies, I've been talking to a lot of my colleagues, and a lot of them have been somewhat turned off about blockchain. And I asked why, and they said because there's just so much fraud in there. Have you heard about the OneCoin case?
Yeah, of course.
Oh,
that's not the case of blockchain. That's just
but I mean, it was presented as a blockchain company, while they had all their data in an Excel spreadsheet. It blows my mind what's happening nowadays. So they presented themselves as a blockchain without even having a blockchain.
Yeah, but that also means that most of the people don't actually understand the technology and they are willing to just throw their money at some scam and hoping to get like twice as much back. So
yeah, but majority of people probably wouldn't understand the code behind blockchain. Even I don't understand the in-depth code. The way I would explain blockchain to an average observer, I would be like, okay, me, you, and Richard, we are playing poker, but we don't have our money or chips with us. I would be like, okay, let's just keep the track of the transaction on paper. And then we're playing, and I would be like, oh, it looks like Richard won $20. But on Richard's sheet, it would be $200. We'll be like, oh, wait, Richard, wait a minute. It doesn't work like this. My ledger says 20 while you have 200. So the thing with blockchain, that all those timesheets, they would update simultaneously. So there's no way that a different ledger would have a different number on it. And this is what blockchain does. It makes sure everyone has the same number written on their piece of paper while they're playing their proverbial poker. And it's impossible to achieve with SQL database or that Excel spreadsheet that the company had. And yeah, it blows my mind that they either didn't understand the blockchain technology behind it, or they were willingly committing a fraud.
Yeah, I think the problem with people is that they are very greedy and they want to earn a lot of money fast. And usually, if assessing risk, if you have been offered like high interest rate on your investment, usually it comes with a higher risk, and that should be taught in school. So if someone offers you like 100% on your investment, it's probably a scam.
Yeah, I completely agree. When something is too good to be true, it probably is. And yeah, financial literacy should be a mandatory subject taught in school nowadays. So
Exactly.
yeah, and I was just wondering, I wanted to talk a little bit about the pathways to financial literacy and prosperity. For example, here in the United States, your credit score is very important. Your employer checks it, your potential landlord checks it. And without proper credit, it's nearly impossible to rent an apartment or find a good job, because the candidate would be automatically labeled as untrustworthy. And to maintain it, to maintain the good credit score, there are certain tricks too. It's not enough to just be debt free. You have to maintain just the right amount of debt. There is a whole science to maintaining the credit score. So I was just wondering, is it the same way in Latvia or in the European Union in general?
I don't know, but in US, is this credit score actually publicly available for each person, or is there some database you can access?
It is publicly available. For example, I can access my own credit score. If I apply for a credit card, the credit bureau or a company can access it, and my landlord can access it, and pretty much everyone who is responsible for making financial decision that involves me, such as employer, landlord, or lender, they have access to that database.
Oh, it's scary. I don't think we have in Europe this kind of, because, for example, in Latvia, the credit score is calculated in each of the financial institutions like separately. So they analyze their own data. Of course, there are some databases that they use, like whether you have been in some, I don't know, didn't pay back some loans or didn't pay for your telecommunications or whatever. But yeah, I think it's better to have some previously paid loans if you want to apply for a mortgage. So I have heard that someone even suggested to like buy some things like a TV, fridge, or something in installments and pay it off faster, just to boost your credit scores for the bank. So when you finally decide to apply for a mortgage, you can negotiate lower interest rates. And yeah, this actually then gives like younger people a possibility to artificially improve their credit score if they know what actions will increase it. And I guess when I was in US last year, I even heard the commercial over radio that some of the companies offer to increase credit score somehow magically. I don't know, but
I don't think it's possible. This actually sounds like a fraud to me. credit
it might be.
Credit score is something that you increase by yourself by responsible behaviors. Factors, for example, in the United States, they include a number of the open accounts you have. It's good to have a lot of accounts in good standing that you manage responsibly. It's good to have a high credit limit, means you manage the credit responsibly with the resources that you are given, but also the age of credit history. But I remember when I just came to the United States for the first time, what blew my mind was it was actually a negative thing to never have been in debt. I remember I was trying to apply for a credit card and I was often being turned down just because I have never been in enough debt yet. But
From machine learning perspective, it means just they don't have any data on you, so they can't make a decision, right?
exactly. But like from the point of view of an everyday user, it's like, why am I punished for not being in enough debt?
Yeah. So that's one side of the AI used in finance.
This is such an interesting topic. I could talk about this the whole day. It looks like we are running low on time though, so I was also wondering for those listeners who are interested to get into machine learning or fintech specifically, maybe one day do what you guys do. Are there any resources or books or you would recommend them to get started? Because we already covered the H2O library and carriers, but is there something else that you would recommend as a good starting point?
For those who are starting, I can suggest Andrew NG course on machine learning. It can be found on Coursera. This was the course I don't know, almost 10 years ago, I guess, when I first started out, and that's one I can suggest. Also for the people who mostly are more in the business, not in tech, there's a course AI for Everyone, taught by the same guy, Andrew NG, that I can totally suggest. There are a lot of books, but yeah, it depends on the previous experience and what are the goals. But I would start with the course and maybe to check some blog posts like towards data science, Medium, and listen to your podcast.
Thank you very much, Richard. I can actually vouch for those sources myself. I looked through that Andrew NG's course on Coursera, and it is excellent. Even if you have much knowledge about machine learning just yet, no problem. He covers everything in a very user-friendly manner, and it doesn't have to be a lot of code. You can just read through the articles and watch through the videos. You would still develop the very good qualitative understanding of the subject. And Medium, of course, I'm following the towards data science myself, and I think it's an excellent resource. And all those resources are free if you're just trying to look, if you're just looking to break into the industry, and you don't want to spend too much money in the very beginning, no problem. All those resources are absolutely free. All right, it looks like we're approaching the end of our episode. Thank you so much, Rihard, for coming in and joining the show. It was an incredibly interesting discussion, and I learned a lot of valuable information.
Thank you for having me with your podcast, and hope to talk with you soon.
Thank you very much. Likewise.